Welcome to TheoTrade. This is Don Kaufman. Here we are doing the weekend update on November 18th, 2017. First and foremost, a quick kind of week in review. What did we see inside of the broader markets? Specifically, we'll start with the S&P futures. One of the things that we can say is, well, we got some more price action and really some two-sided trade. And for those of you that don't necessarily, speak kind of trader lingo, that means we didn't just move to the upside. We had two-sided trade. We had some days where the week started off with some sell-side activity followed by a rally. What did we see on Tuesday? Some sell-side activity followed by a rally. That was the end of each day. On Wednesday, we had some pretty phenomenal sell-side activity met by a rally back. Got back portion of it. Thursday was an explosive rally to the upside over here. And again, what we're looking at is just a 1 hour chart followed by Friday. And I think Friday caught a lot of people by surprise as the S&Ps, they were strong throughout the course of the morning. And they whacked them in the last, sold them off in the last 2 hours of the trading session. Specifically, the line kind of bisecting your screen over here happens to be 25.75 on the button inside of the S&P futures. And the irony of the entire week, where did we end up? Absolutely unchanged for the entire week. So you had, bullish traders claiming victory ultimately on Thursday, bearish traders claiming victory on the entire week. And the reason the bearish traders are claiming victory on the week, you can't even make this stuff up, people. I mean, if you look at the SPX, again, we're kind of zooming in, and here's our expected moves. Last week, the SPX closed at 25.82. And that's, again, the previous week's close. And this week, they closed them at 25.78. So you're looking at a market that's diminished by about 3 S&P points, which means absolutely nothing on a $2,000, almost $600 product. But the biggest takeaway, from here is you're starting to feel like you have a marketplace on the edge. On the edge of what? It's, on the brink. And it's, that doesn't necessarily mean that it's going to break down. And I think a lot of people misinterpreted some of the comments that, I made. It happened to be this past Wednesday, when on Wednesday, we were still looking for a very large move coming for Thursday and Friday. And we got that, but it happened to be ultimately to the upside. And what I'm going to describe here, and I'm going to be very forward looking, is just this. We have a marketplace now that's on the edge. I mean, again, you've got bearish traders coming out of the woodwork over here talking about, the infinite number of problems. Bullish traders says doesn't matter, going to buy the dip over here. Now, I actually have a bias. I'm in the much more bearish camp, but that's a little bit more duration. But I can tell you one thing quite definitively right now is put the bias aside and recognize when I say the marketplace is on edge, it has a lot to do with what I'm seeing in terms of volatility, both implied volatility. Implied volatility is forward looking, and forward looking has a lot to do with the option pricing, and historical volatility. And historical volatility is actual price movement. So let me remind everybody that in this past week of trade, I'm going to kind of draw this up over here. In this past week of trade, what we ultimately had was an expanded expected move. And the marketplace hasn't done this in a while, but we were looking for a $31 move either higher or a $31 move lower. Now, an expanded expected move is neither bullish nor bearish. It just means it's coming. More volatility is coming. In this past week, we didn't quite touch down, to the $31 move. We got fairly close. The wild rally back on Thursday just really took us kind of back to even on the week, and we ended up the week literally where we started. But as I said, kind of a market on the edge, and I'll describe this much more in just a moment. If you're forward looking, and that's what this expected move happens to be, first of all, we are coming into a holiday trading week. For those of you not aware, maybe not in the United States, we are coming into the Thanksgiving holiday week, which ultimately, what do we have for trade? All right, so we have Monday, we got Tuesday, we have Wednesday. Monday, Tuesday, Wednesday, though Wednesday by the midday, everybody pretty much packs up, takes off. Thursday, Thursday, the markets are closed. And then Friday, the market is open, but it's only half a trading session. So you only get about 3.5 hours of trade. And what's interesting is the expected move in this coming week is plus or minus about 21. Okay. And you're like, okay, so that's a lot less than the previous week, right? Yeah, but the previous week was a full 5 trading days. Here, we legitimately, let's like discount Friday completely, legitimately only have about 3 trading days, and we're still looking for a $21 expected move, which I have to tell you, kind of surprised me. And the reason that surprised me is, yes, last week we saw like a $31 expected move. The week before that, though, in a full trading week, we had about a $21 expected move. So we're still seeing, substantially higher risk markers than we did again, in some of the previous weeks. Given the fact that we only have 3 trading days, we're seeing a decent amount of volatility packed in there. And that's notable. Again, looking at the November 24th, again, this is a half a trading session. We're still looking, at almost a $21 expected move, which, and again, I like to kind of compare and contrast in order to do that. If you take a look right up here at the date box, that's just going back to, here we are in the 18th of November. This is going back exactly a week. You can see it was a $31 expected move, right? Go back a previous week, right to the 4th, and we'll actually pull data from the 4th and look a week out there, and you'll see there it is, about a $21 expected move. But that's a $21 expected move with a full 5 days of trading. So regardless what you might think about a holiday week, right, we're still anticipating more movement. And I'll show you specifically why. If we come over to the SPX chart here, and again, all the expected moves, it's a lot to kind of look at on the chart. All the expected moves aside, what I talked about specifically on Wednesday was historical volatility. That was actual price movement. And I came over to studies. We'll cruise down to volatility studies, come up to historical volatility. Now, the historical volatility, it's the annualized standard deviation of the past stock price movement. I'm going to take the historical volatility and I'm going to knock it down, just to a 5, all right? And the 5 length, ultimately, it's a shorter duration historical volatility. It's showing kind of price movement over the last like 5 trading days. And again, on Wednesday when we caught this, and I'll kind of zoom in and zoom back out, on Wednesday when we caught this, it was right in this neighborhood here where it was still in the 3% range. I want you to see how fast that moved up. That was the point to be, I guess, that's the point we tried to make in Wednesday, that large movement was pending and right around the corner. Did we know the market's going to move up or down? Absolutely not. And I'm going to make that exact same argument right now. We're still anticipating some fairly large moves inside of the marketplace. And if you ask me the bias right now, all I can tell you is that risk assets are on edge. And again, that's what we have right now is, it's a market on the edge. On the edge of what? Well, we're hitting a crossroads. And now I'm actually going to show you. So we increased historical volatility here for just a moment, but let me show you what I mean by on edge. Okay. We'll cruise over to the bond market for a second because the bond market, it's dictating a lot more than I think that meets the eye. Like not enough people are talking about it's forget about the direction of the bonds for a second. The bonds are just having wild movement. And if you haven't heard about this, I'll give you the crash course in it right now. What traders are discussing inside of the bond market, it's not so much the larger movement in these bonds, which it absolutely, like the reason that I bring up the bond chart is because I think it speaks volumes. The bonds themselves are having very large moves on a day-to-day basis, and they're just waffling back and forth with ever-increasing ranges. To me, it's a little bit alarming. Now, and again, it's alarming on a front that How is this going to play out inside of the S&Ps? Don't know yet. However, the talk of the town over here happens to be what they call the yield curve. Okay. And what the yield curve is comparing, it's comparing like, 2-year interest rate, for instance, to 5-year interest rate, okay, out to 10-year, and even all the way out to like 30-year. And what you ultimately get, okay, in a more, I guess, normalized curve, and this is where we start talking a little bit about yield curve. Yield curve, the yield is the interest rate associated with the 2-year, the 5-year, the 10-year, the 30-year. You can look all of this stuff up, okay, on most of your trading applications, but I'll kind of describe it. Typically what we've seen is like, the yield of the 2-year would almost be like literally, 0.05, maybe a 5-year, and I'm just going to throw some numbers out really quick. 1%, the 10-year might jump all the way out to like, 2.4%, and then the 30-year might be somewhere around 3%, okay? Now that's what maybe we saw in like a 0.5% over here, like really? Actually this was, the 2-year for a period of time was literally sitting at, next to nothing. But what we've seen is these 2 years have been taking off to the upside. And what it's ultimately doing is what they call flattening the yield curve. When the yield curve typically looks something like this, right? So here's your 0.5%, your 1%, let's call it 2.4%, and all the way out to 3%. Again, on the 2-year, the 5-year, the 10-year, and the 30-year. What you're getting right now is the yield curve, okay, is gradually, it's gone from a steeper yield curve to a much flatter yield curve. And the signal that might be sending, and again, you guys can look some of this stuff up. So there's a number of symbols that you can look up, like TNX. If you haven't seen like TNX, TNX is the interest rate associated with the 10-year. It's the 10-year Treasury Index. Right now, it's about 2.3, right? And I'm just throwing some numbers out here. So there's TNX out there, and I've even set up in the past different like rate comparisons. So if you take a look at like my rate comparison over here, what I'm actually doing is it's TYX, okay, versus TNX. The TYX happens to be the 30-year. And you can see some of the differential in that yield curve. So, and again, I don't want to go too deeply into this. I'll spend some time during the week here at TheoTrade kind of going through specifically some of that yield curve. All right, so on this note, this is one of the risk assets that I don't exactly know what to make yet of the yield curve, but you can tell, one thing from it. All right, there's a lot of uneasy trade. And the reason there's a lot of uneasy trade regarding this yield curve is when the yield curve flattens out, most traders will say that, well, that's the signal that we're headed into a recession, but I don't think you can necessarily call it that just yet. More often than not, the yield curve has been a great indication of economic slowdowns when the yield curve started to invert. And the reason I don't necessarily buy into that is simply put, I think the Fed will backstop it. And still has much more influence than we give them credit for. And that includes when we have the new Fed chairperson, Powell coming in. I think they have enough influence over it. It's the increase, though, in volatility of the bonds themselves. And you have to realize what it means is the Fed is not going to be able to get ahead of the volatility inside of the bonds. And the bonds could make an explosive move either higher or lower right now. And I think that's one of the big takeaways that's got a lot of traders on edge. The other thing that I've really been keying into a lot lately happens to be the VVIX. It's the volatility of the volatility index. And this, it's far more important. Like, I know people are like, where is, Google going to go? Let me tell you something right now. All the risk assets say nobody has a clue as to even a day into the future of this marketplace right now. Again, as I said, I'm a duration kind of much more bearish on markets. I think that could still take, though, a long time to play out. But one of the things, again, that you can look at that is definitive is this is what professional trade thinks about markets right now. And you're like, so what does that mean? Well, the VVIX, the volatility of the volatility index, they're keeping this thing bid above 90, like it's just going out of style over here. And it's pretty shocking because if you look back at the history of this product, there's really no points where it stays bid like this, okay, for this substantial period of time. I mean, it literally hasn't dipped under 90, okay, for a fleeting moment out there. It's a new kind of like paradigm in higher volatility of the VIX. And what it kind of tells us over here is the professional trading community, okay, is absolutely on edge. And I'll be clear about this. This tells me that they really are, okay, worried about a fast and precipitous drop in the market. That's the only way you can describe the VVIX, because what the VVIX is indicative of, okay, it's indicative of heavy call activity inside of the VIX. So if you open up the VIX and you look out, you know, standardized options over here, and you start just open up like all the strikes you possibly can, go to volume and open interest, right? What it takes to move the VVIX is a big bid. It's buyers. Let me just make that clear. It is buyers, okay, of options right around this December timeframe. And I mean, the contract size out there, that's just yesterday. You know, it's nothing less than monumental, some of the contract size that we're seeing trade through the VIX. And that to me, consequently, is a much more kind of bearish undertone to the marketplace. Because again, what it means is that, you know, you're talking about, all these people are talking about like, I'm so short volatility. Yeah, well, these traders over here, they're buying the edges of volatility. They're buying out of the money options, okay, likely in the VIX, just in case we absolutely crater. So whenever the VVIX is elevated like this, it kind of puts you on spider sense. You know, you're waiting and ready for a move. Now, I'll switch gears. As I said, this is a market on the edge, and we have a number of risk assets. We've seen bonds edgy, throwing off big moves. Okay, the VVIX continues to be elevated over here. Obviously, we're seeing the S&Ps throw off larger ranges. The implied volatilities have come back a little bit in here. Okay, another area that I think is of critical importance. You know, you're also seeing the XLF waffling back and forth here, and that has a tremendous amount, of course, to do with the bond market as well. Now, to kind of like, you know, really finish up on this theme, okay, of, again, risk assets, VVIX lit to the upside in the coming week, and it's a shortened trading week, watch some of the most key products out there. And when I'm talking about key products, I know everybody's got like, you know, eyes on Apple, okay, but this will fall by the wayside a little bit. Watch some of the key products that are involved in this. Microsoft would actually backed off quite a bit throughout the course of the week. Microsoft even cracked the lower end of its expected move, okay? Watch a product like, for example, Intel, which again, and you know, this falls off everybody's radar screen a little bit here, but Intel, which actually fell by an amount of 2%, there are a few, if you will, marquee stocks that are not necessarily on everybody's radar screen. Okay, in terms of technology, again, those happen to be very, very specific. Microsoft, okay, Intel, the market caps that they're capable of moving are substantial. And again, they saw some sell side activity kind of late in the week, breaking through their bottom expected move. Even though we're coming in to a shortened holiday week, expect more movements in markets, it looks like, moving forward. Thanks everybody for joining us at TheoTrade. Have a wonderful weekend. Bye-bye.